I think when the Fed goes back to stimulus and creating inflation, when inflation is maybe double or triple or quadruple that 2% target, the markets are going to react very differently than how they reacted in the past. Because in the past, the Fed was able to justify all this cheap money because they said we don't have enough inflation. We're still below target. Well, when they go back to this stimulus, when inflation is triple or more their target, the markets aren't going to buy it. And so I think all the inflation that they are going to have to create in order to stimulate the economy out of this recession is going to ignite a powder keg. We already have an inflation problem, and Powell's going to pour all this gasoline on it. And so we're going to see inflation moving up to a much higher level, even though it's already very high. In fact, it's probably double what the government claims in the CPI. If you want to know what's actually happening to prices, you've got to double what the government tells you, and that's more accurate. Meanwhile, labor force participation last month fell to 62.1. That is the low for the year. And in fact, over the last 4 months, even though we've created all these jobs, the number of people in the workforce has gone down. And so that means that all the jobs that were created over the last 4 months were people who already had a job getting another job. You know, Biden claimed that we have a record number of people in the workforce. He was mistaken. We had more people working 4 months ago than we have working now. The record high for the number of people working is before the pandemic. So even though we've recovered the jobs that we lost prior to the pandemic, it's only because the same people have multiple jobs. We haven't recovered the workers. We still have a lot of workers that were working prior to the pandemic that haven't rejoined the labor. So by that definition, we've already crashed, or it's a hard landing. It is what it is. And so you have all these Keynesians that somehow believe that inflation is caused by economic growth. They also think it's caused by too many people working. They think there's a trade-off between unemployment and inflation. They think if there's not enough people unemployed, you're going to have more inflation. And the way to get rid of inflation is to put people out of work. All of this is Keynesian nonsense. Inflation is not caused by the private sector. It's not caused by growth. It's not caused by people working. The only people working that cause inflation are the people at the Fed who are running the printing presses or pushing all the buttons that are creating all the money. That's where inflation comes from. And they create inflation in order to monetize U.S. government debt. So the federal government runs a big budget deficit. The Federal Reserve prints up money to buy those bonds, and that inflation enters the economy. It's got nothing to do with growth or people working. As a matter of fact, in a real economy, the stronger the growth, the lower prices. Because what is economic growth? It means increased output. It means more goods and services are being produced. Well, if you increase the supply of something, then you decrease the price. So a productive economy that's producing more stuff means that the price of that stuff is lower. The same thing with people working. If more people are employed productively, their productive output is increasing the supply of goods and services, keeping the prices down. If you slow down real economic growth, if you force people out of work, you're going to have less supply. We're not going to make as much stuff. We're not going to be offering as many services. And so therefore, the prices of those goods and services, all else being equal, are going to go up. Supply creates demand. So if people are producing and putting goods and services into the economy, well, now they have the ability to share in that production. They've earned money helping to create stuff, and now they can spend that money to buy the stuff that they created. And so the demand that comes from real production doesn't cause prices to go up. The only kind of demand that causes prices to go up is when the government just prints money and gives it to people. And so that money is not a function of production. People didn't earn that money producing. They just were sent the money by the government. I mean, that's what happened during COVID to a huge degree. You had people who had jobs and were working to help make stuff. They went home. They weren't working at all. They weren't making anything. But now the government sent them money. They weren't earning money because they worked. They were being paid not to work. But the worst part about it was many people were paid 2 or 3 times not to work than what they earned when they were working. So now these people who weren't working at all had all this money to go and buy stuff, but they didn't help produce any stuff. That's what pushed up prices, because you had all this fake demand and no supply. If everybody was going to stop working, the Fed should have shrunk the money supply, not expanded it. The U.S. government should have cut spending, not spent more. That would have balanced out supply and demand. But instead, we had the worst combination of monetary and fiscal policy probably in the history of the country. In the face of collapsing supply, we flooded the economy with phony demand. And so we're experiencing now, I think, just the beginning of those consequences. We've got a long way to go, which is why the idea that inflation has peaked is nonsense. Historically, whenever they brand a piece of legislation, whatever the name is, the effect will be the opposite of that name. So if a bill is called the Inflation Reduction Act, then you know right off the bat, the effect of the bill is going to be to increase inflation. And that's exactly what it's going to do. First of all, there's all this new government spending. That's more demand, artificial demand, coming into the economy. How is the government going to get all this money that it's going to spend? Because it's not going to get it from those tax hikes. It's ultimately going to get it from the Fed. The Fed is going to have to print more money to monetize those debts. Now, even if the Fed doesn't do that and the government has to find private buyers for those bonds, well, then it's going to crowd out investment in the private sector. And so that's going to mean fewer things are going to be produced because the private sector is going to have less money to invest in capital and things to improve productivity. And so that ultimately causes prices to be higher. So will the increase in corporate taxes, because to the extent that corporations have to pay higher taxes, it comes at the expense of lower investment. So if corporations have less money to invest in plant and equipment and expanding supply, that ultimately puts upward pressure on prices. What the government needs to do to reduce inflation is reduce government spending. We need a bill that cuts government spending. The government is doing the opposite. They are increasing government spending. So what they're doing is they are throwing gasoline on a fire that's already burning hot. The government makes everything more expensive. It's the free market that makes things less expensive. So if we want to help put downward pressure on prices, we got to get government out and let the free market in. Now, in fact, they may be cutting interest rates before the end of this year, but it's not going to be because they've won a victory over inflation. It's going to be because the economy is in a much more severe, in other words, this recession that's here is going to get worse, and that's going to force politicians to try to do something. You know, once the political pressure is greater because of unemployment and the economy, then the Fed is going to switch its attention from inflation. But the inflation problem is not going to go away. It's just that this other problem is going to loom larger in the eyes of the Fed. And I think what's driving the markets is this bad news on the economy is good news for the markets because it means the Fed will pivot sooner. And before it pivots, it will raise rates less than it might have raised, absent the bad economic news. And again, you still have all of these Keynesians out there that think bad economic news is good news on inflation. They think the weak economy will weaken inflation. It won't. It is going to strengthen inflation, especially when the Federal Reserve and the government respond to the weakening economy with more stimulus, because that stimulus is inflation. So they're going to start creating more inflation, even though we already have too much inflation. And so the problem is going to get much bigger than the markets understand. I still think this is an overall bear market. I think that rate hikes are going to continue to take their toll, but so will inflation. I think inflation is going to harm a lot of companies that have a problem dealing with it. I think a lot of demand is going to be destroyed for a lot of discretionary items because people are going to spend all their money on food, on energy, on insurance, on rent, on taxes. Well, I think the nature of this financial crisis is going to be a lot different than the one we had in 2008, because I don't think the Fed is going to allow it. That's one of the reasons I believe that Powell is going to pivot, because if the Fed does keep raising rates, we will have a financial crisis that looks like 2008, only much worse, because 2008 was about bad debt. It was about people borrowed money and they couldn't pay it back, and the collateral for the loans was no good because it was real estate and prices went down. Well, we have much more debt now than we had in 2008. I mean, by an order of magnitude. Everybody has more debt than they had back then. And so this is going to be a much bigger crisis when the defaults start. And all those banks that were too big to fail, that were bailed out in 2008, they're a lot bigger now. And when they fail, it's going to be a lot worse, except with inflation too high and the Fed fighting inflation, there are no bailouts. There's no TARP 2.0. All these banks are going to have to be allowed to fail. And that means customers are going to lose money, not just stockholders or bondholders. The customers are going to lose money because the FDIC doesn't have any money unless it gets it from the Fed. And the Fed isn't going to be giving out money if it's fighting inflation. It's taking away money. So I believe the Fed is going to pivot to prevent that massive financial crisis. And so what we're going to get is a sovereign debt crisis and a US dollar crisis. So it's going to take the form of a crashing dollar. The people that are just holding subprime mortgages, but the people who are holding U.S. Treasury bonds or any bonds denominated in U.S. dollars, or even people that have U.S. dollars stuffed under their mattress. You know, the dollar has risen so far in the early stages of this big inflation because investors are still delusional about the Fed's ability to contain inflation and bring it back down to 2%. When they wake up to reality that inflation is going to be way above 2% indefinitely, then the dollar is going to fall through the floor, and then things like gold and silver will go through the roof. Remember, in 1971, the U.S. defaulted on its obligations because Nixon took us off the gold standard. But prior to that, if you owned a Federal Reserve note and you were a foreign central bank, you owned an obligation of the United States government to pay you gold. Federal Reserve notes were notes for gold. And the U.S. government defaulted on those notes. We told all of our international creditors, we promised to pay you gold. If you had $35, we promised you an ounce of gold. And they did a couple of devaluations first, but that wasn't enough. And then Nixon said, you know what? We're going to default completely. We're going to give you no note gold for your notes. We're going to pay nothing. So that was an official default. And then gold went from $35 an ounce up to $850. So people who had U.S. Federal Reserve notes thought they were going to get a certain amount of gold. They ended up getting a fraction of that gold because the value of the dollar imploded relative to gold because we defaulted on that promise. And I think it's going to lose its status as the reserve currency. And that is going to be a game changer for the U.S. economy because we rely on the ability to exchange the paper we print, U.S. Federal Reserve notes, dollars, for the goods the rest of the world produces.